In March 2000, NASDAQ hit 5,048.62. By 2002, it was roughly 78% lower. The internet was real. Its price was feverish. .com names multiplied. Money chased tomorrow. Profit was supposed to arrive later. Then came the question, where was the money? Pets.com planned liquidation by November 2000. Rewind, why did a real technology cause this? The web did not begin as a stock chart. It began as a new way to publish, communicate, and find things without asking a gatekeeper for a slot in the newspaper or a shelf in a store. In the 1990s, commercial use of the internet opened up. Browsers competed, access providers spread, and thousands of companies tried to build businesses on the same new plumbing. Netscape's August 1995 IPO became the era's starter pistol. It did not create every later excess, but it showed Wall Street that a browser could suddenly be a public market event. The fantasy had a solid core. A browser made the network feel usable to ordinary people. That is why the story is not, and never was, that the internet itself was fake. As more people came online, every company wanted a web strategy. Sometimes that meant a real product. Sometimes it meant a new domain name stapled to an old business and a very brave press release. The important word was scale. If a service could reach millions, the future might be enormous. That possibility was exciting. It was also an invitation to price years of success before the years had happened. By April 2000, the SEC said almost 7 million people were investing through online brokerage accounts. Market access had become a browser tab. The refresh button was suddenly part of Wall Street. Money met the web at speed. Venture capital backed ideas, founders hired teams, and each new round made the next round feel less like a question and more like proof. The spending boom was real. From 1996 to the 2000 peak, U.S. real business investment grew about 10% a year, far faster than the economy overall. Computers, software, and networks were everywhere. That did not mean every dollar was foolish. It meant the crowd was paying for an uncertain future all at once. A useful idea and a finished business model are not the same species. The loop was powerful. Attention attracted capital. Capital bought advertising and servers, and the extra visibility attracted more attention. Growth looked like a destination even when it was mostly a treadmill. Get big fast became a logic, not just a slogan. The race was to become the default before a rival did. Costs could wait. Markets were supposedly about to become infinite on schedule. Telecom builders laid more capacity for the coming digital world. Servers were installed. Fiber was run. In a boom, building ahead can look exactly like genius, right until demand arrives on a different timetable. And above all of it sat the market. It had a simple job: turn stories about future scale into prices today. That translation was about to become dangerously enthusiastic. Between September 1998 and March 2000, the NASDAQ composite rose 170%. The line did not climb like a staircase. It climbed like it had remembered an appointment in space. An IPO was no longer just a company joining the market. It could become a public coronation for an idea, complete with analysts, television cameras, and a price that arrived before the business had settled. Every launch needed a story. First mover, category killer, network effects, eyeballs. These were useful ideas. In the frenzy, they became a kind of confetti thrown over almost any spreadsheet. Pets.com became the era's cartoon mascot because the logistics were stubbornly real. Shipping heavy pet food was not solved by a sock puppet, a Super Bowl ad, or a charming URL. At the peak, old media and new media hurried to join hands. The future looked so inevitable that even giant combinations could be sold as a shortcut to owning it. Scale was the magic word because the web really could lower distribution costs. But lowering one cost does not erase every other cost. Warehouses, support, marketing, returns, and the awkward human need to be paid. At 5,362, the chart had become a monument to expectation. The higher it went, the less room there was for an ordinary disappointment. And business eventually specializes in those. The warning was not that the web had no future. It was that future customers, future profits, and future dominance were being treated as if they had already checked into the quarterly results. A free online service can delight millions and still need a way to pay its bills. Research later put it neatly. Consumer value was abundant. A profit recipe for most free .com services was not automatic. Meanwhile, businesses built capacity for the demand they expected, not always the demand that arrived. Fiber, servers, and offices can be useful assets. They can also be a very expensive waiting room. A valuation is a claim on what a business may eventually produce. In the bubble, claims about the far horizon became so large that small doubts in the near term could suddenly matter a lot. The new economy story had gravity. Headlines rewarded speed. Pitch decks rewarded optimism. None of that required a secret room. Incentives can make a crowded room lean the same direction by themselves. Later, regulators confronted conflicts between investment banking and brokerage research. In 2003, a federal court approved a $1.4 billion settlement involving SEC enforcement actions against 10 major firms. By early 2000, the market did not need every company to fail. It only needed the old story, growth will fix everything later, to stop feeling automatic. That change arrived fast. After the March 2000 peak, the NASDAQ began falling. The first drop was not a magic trapdoor. It was a repricing, then another repricing, then a crowd discovering that exits can have traffic. Once the line points down, funding becomes harder, expansion plans become heavier, and every promised future is judged with a little less patience. The same uncertainty that once looked thrilling now looks expensive. Pets.com is the cleanest date stamp on the bust. Its board adopted a plan of complete liquidation on November 4, 2000. The company was delisted from NASDAQ the following January. Other businesses shrank, closed, or retrenched. Some had a bad model. Some had a reasonable model, but too little time. In a financing drought, those can become the same ending. The broader economy also weakened. NBER dates the U.S. recession from March to November 2001. The dot-com bust mattered, but this was not a one-button story with a one-button cause. On October 9, 2002, the NASDAQ closed at 114.11. From the March 2000 peak, that is about a 78% fall. The rocket had returned to Earth with paperwork, but a collapsing chart is not the whole human story. Behind every closure were teams, suppliers, customers, and people who had treated a strange new decade as the future of their work. The human cost of a boom is easy to hide when everyone is talking about paper wealth. The bust makes it visible: canceled plans, empty offices, and a career ladder that suddenly has missing rungs. Most employees did not design a bubble. They wrote code, packed boxes, answered support tickets, or moved to a new city because a company looked like it was building something important. A company can be wrong, early, or both. The bust punished all three without much patience. That is the ugly part of a rush. Timing becomes a verdict before the technology finishes growing up. The shock also traveled outward. When fast-growing companies stop spending, landlords, advertisers, equipment sellers, and contractors discover that somebody else's future was sitting in their current invoices. And there was embarrassment. Bubbles make confidence look intelligent until they don't. People who had been praised for seeing the future were now explaining why the future had not returned their calls. The reset was painful, but it also forced a boring question back into the room. Can this business actually keep going when the cheering stops? Boring questions are often the last ones invited to a party. The surprise is that the internet did not disappear with the valuation bubble. The wires, code, and habits were still there. The next chapter is about what survived the hangover. The excess capacity did not evaporate. Fiber remained in the ground. Servers remained in racks. The infrastructure built too early became part of the foundation that later internet businesses could use. That distinction matters. A new technology can change daily life and still be surrounded by bad timing, bad incentives, and bad prices. One truth does not cancel the other. Online commerce, software, and digital communication kept becoming ordinary. The bubble did not prove the web was useless. It proved that a lasting shift can still be wrapped in a temporary mania. The companies that endured had to keep solving ordinary problems after extraordinary capital had left the room. Customers still needed a reason to return. Bills still needed a way to be paid. Regulators also drew clearer lines around analyst conflicts. The point was not to outlaw optimism. It was to make the sales pitch and the supposedly independent research less able to share the same megaphone. Every generation invents a phrase for why this time is different. The dot-com bubble left a better phrase. The technology can be different. The math still has to show up. So what exactly burst? Not the web, not curiosity, not the idea that software could reshape daily life. What burst was the claim that every digital future deserved its full reward in advance. The dot-com bubble was not a story about fake technology. It was a story about a real revolution meeting a market that tried to prepay the ending, and then asked the ending to arrive on Tuesday. That is why this bubble still matters. It is possible to be right about a change and wildly wrong about the timetable, the business model, or the price attached to the story. That was the dot-com bubble, how a real invention met runaway expectation, and how the money vanished before the technology did. Like and subscribe for the next boom and bust story.